$80 silver in China. Right now, the liquidity crisis has started. Stop checking the price on your screen because what you're seeing is not real. Right now, while most traders sleep through the holidays, something catastrophic is unfolding in the shadows of global markets. Silver is trading at $74 in New York, but in China, industrial buyers are paying over $80 for the exact same metal, a $5 gap. In commodity markets, a $5 divergence doesn't just signal opportunity, it signals a broken system. The arbitrage mechanism that keeps prices aligned across continents has stopped functioning. Metal is draining from Western vaults, flowing east, and it's not coming back. Dealers have frozen sales, premiums have exploded, and we are 11 cents away from a technical trigger point that could send this market vertical in minutes. This is not speculation, this is the liquidity crisis of December 26th, and it has already begun. Welcome to Financial Announcement, where we decode the economic shifts that shape your financial future. I'm Marcus Thornhill, a financial analyst based in London, and for the past 15 years, I've tracked commodity markets, monetary policy, and the structural fractures that most investors never see coming. Today, we're investigating a story that's unfolding right now, a story about what happens when paper markets collide with physical reality. Now, before we dive into the mechanics of this crisis, I need you to do something. If you've been watching financial markets longer than I've been alive, if you remember when gold was $40 an ounce and a handshake still meant something, then you understand the value of sound analysis. Hit that subscribe button, not because I'm asking, but because you know what's coming next matters. And tell me in the comments, where are you watching from today? Let's begin. On the morning of December 26th, 2024, a financial analyst in Singapore opened his trading terminal and saw something that made him freeze. Silver was trading at $74.89 on the New York Exchange. Standard price, nothing unusual. But when he switched to the Shanghai Gold Exchange, the number on his screen read 595 yuan per gram. He did the conversion twice, then a third time, certain he had made an error. He had not. The physical price of silver in China, when converted to dollars and adjusted for actual delivery costs, was trading above $80 per ounce. The gap between New York and Shanghai was not 50 cents, not even $1. It was over $5. In the world of commodity trading, where prices are supposed to align globally within seconds, a $5 divergence is not an anomaly. It is a structural failure. For decades, the silver market has operated on a simple principle. If silver is cheaper in London than in New York, traders buy in London and sell in New York. This process, called arbitrage, keeps prices balanced across the world. The difference between markets rarely exceeds a few cents because arbitrageurs move faster than the price can drift. But on December 26th, that mechanism broke. The Shanghai Gold Exchange is where Chinese manufacturers, jewelers, and industrial buyers come to purchase physical metal. Unlike the COMEX exchange in New York, which trades primarily in paper contracts and futures, Shanghai deals in actual bars and coins. When a buyer purchases silver on the SGE, they are committing to take delivery of real metal, not a financial derivative. This distinction matters because it reveals true demand. In recent weeks, Chinese solar manufacturers have been rushing to secure silver paste, a critical component in photovoltaic panels. Battery producers need silver for conductors. Electronics companies require it for circuit boards. All of these industries operate on tight year-end procurement schedules, and all of them converged on the Shanghai market in late December. The result was a buying frenzy that pushed the exchange price to 595 yuan per gram. But the published exchange price is only part of the equation. When a Chinese buyer actually takes delivery, they must pay value-added tax, transportation fees, and physical handling premiums. In the streets of Shenzhen, the real cost to put a silver bar in hand has exceeded $80. This is not a theoretical number. This is what industrial buyers are paying right now. Meanwhile, in New York, the COMEX futures market continues to trade as if nothing has changed. The ticker shows $74.89. Analysts on financial television discuss the recent $3 rally and debate whether the momentum will continue. But none of them mention the $5 gap, because most of them are not watching Shanghai. This divergence exposes a fundamental truth about modern commodity markets. There are two prices for silver. There's the paper price, determined by futures contracts, options, and derivatives traded in New York and London. And there is the physical price, determined by actual supply and demand for metal that can be touched, stored, and delivered. Under normal conditions, these two prices stay close together because arbitrageurs bridge the gap. But when arbitrage fails, the two prices separate and the market fractures. Why is arbitrage failing now? Because moving physical silver from New York to Shanghai takes time. A trader can buy a futures contract in New York in milliseconds, but shipping a pallet of silver bars to China takes 3 to 6 weeks. During that time, prices can move. Refineries must process the metal. Logistics companies must arrange transport. Customs officials must clear the shipment. Every step introduces delay, and in a fast-moving market, delay is risk. The $5 premium in Shanghai is not a distortion. It is a signal. It is the market screaming that physical metal is scarce in the East and that the paper price in the West is no longer reflecting reality. Arbitrageurs see the opportunity, but they cannot act fast enough to close it. The gap remains and it is widening. This is how market infrastructure breaks, not with a dramatic crash, but with a quiet divergence that grows until the system can no longer ignore it. The question now is not whether New York will rise to meet Shanghai. The question is how fast it will happen and what breaks along the way. There's a week every year when the global financial system operates on autopilot, and no one talks about it. The last week of December is not a holiday in the technical sense. Markets are open, prices move, transactions occur, but the humans who normally control those markets are gone. What remains is a skeleton crew of junior traders, a handful of algorithms, and a liquidity environment so thin that a single large order can move prices in ways that would be impossible during normal trading conditions. Wall Street calls it Ghost Week. On December 26th, the trading floor at JP Morgan's commodities desk in New York was nearly empty. 3 junior traders sat at terminals normally occupied by 15. Their instructions were simple: monitor the systems, do not take large risks, and call senior management only in the event of a genuine emergency. Across the river at Goldman Sachs, the situation was identical. In London, the metals trading desks at major banks were operating with less than 20% of their usual staff. The senior risk managers, the ones who make decisions about position limits and hedging strategies, were unreachable. This is not negligence. This is standard practice. December is when the financial industry shuts down. Bonuses have been paid. Year-end reports have been filed. The people who run the markets take their families to the Alps or the Caribbean, and the markets are left to run themselves. Under normal circumstances, this works fine. Trading volumes drop, volatility stays low, and the algorithms maintain orderly markets until everyone returns in January. But December 26, 2024 was not normal. At 8:43 in the morning, Eastern Standard Time, a buy order hit the COMEX silver market. The order was large, approximately 2 million ounces, and it was structured as a market order, meaning it would purchase at any available price until the full quantity was filled. In a liquid market, this order would have been absorbed with minimal price impact. Market makers would have stepped in, sold from their inventory, and the price might have risen 10 or 20 cents. But the market makers were not there. The order tore through the ask side of the order book like a freight train. It bought every available contract at $71, then $72, then $73. Within 90 seconds, silver was trading at $74.89. The move was vertical. There were no pauses, no pullbacks, no resistance. The price simply teleported upward because there was no one on the other side to sell. A liquid market is like a deep pool of water. When you jump in, the water absorbs the impact and the surface barely ripples. And a liquid market is like an empty pool. When you pour water into it, the water splashes everywhere because there is nothing to contain it. Ghost Week turns the silver market into an empty pool. The algorithms that normally provide liquidity are programmed to pull back during periods of extreme volatility. When prices move too fast, the algorithms step aside to avoid getting caught in a runaway move. This is a safety feature, but it creates a feedback loop. Fast price movement causes algorithms to withdraw, which removes liquidity, which causes even faster price movement. On December 26th, that loop activated. By 9:15, trading volume had collapsed to less than 30% of the daily average. The bid-ask spread, which normally sits at 2 or 3 cents, had widened to over 50 cents. This means that the difference between what buyers were willing to pay and what sellers were willing to accept had exploded. In practical terms, the market had stopped functioning as a price discovery mechanism. It had become a one-way elevator, and the only direction was up. The buying pressure was not random. It was coming from systematic hedge funds and Chinese industrial buyers who had been waiting for a quiet moment to execute large orders without moving the market. But in Ghost Week, there is no such thing as a quiet execution. Every order is loud, every trade echoes. What made this moment more dangerous was the complete absence of human judgment. Normally, a senior trader would see the price action, recognize the instability, and either step in to provide liquidity or call a halt to trading until conditions normalized. But there was no senior trader. There was no one to make that call. The market was running on automatic, and automatic does not understand panic. In the industrial district of Shenzhen, a procurement manager named Chen Wei was having the worst week of his career. His company manufactures solar panels, and every panel requires a precise amount of silver paste to create the conductive pathways that turn sunlight into electricity. Without silver, the production line stops. Without production, the company misses its quarterly targets. And missing targets in the Chinese manufacturing sector can mean the difference between survival and bankruptcy. Chen had been trying to secure 5 tons of silver since December 20th. His usual suppliers told him the same thing. Inventory was tight, prices were rising, and if he wanted guaranteed delivery before the end of the year, he would need to pay a premium. The first quote he received was $78 per ounce. 2 days later, the same supplier called back and revised the price to $82. Chen had no choice but to accept. This was not unique to Chen's company. Across Shenzhen, Guangzhou, and Shanghai, the same conversation was happening in boardrooms and procurement offices. Battery manufacturers needed silver for lithium-ion conductors. Electronics companies required it for printed circuit boards. Medical device producers used it for antimicrobial coatings. Every one of these industries operates on just-in-time inventory systems, which means they do not stockpile materials months in advance. They order what they need when they need it. And in late December 2024, they all needed silver at the same time. China consumes more than 40% of the world's industrial silver. This is not investment demand or speculative buying. This is actual industrial consumption, metal that gets turned into products and never returns to the market. When Chinese factories ramp up production, global silver supplies tighten immediately. And December is one of the highest production months of the year because manufacturers are racing to meet year-end contracts and prepare inventory for the first quarter. The Shanghai Gold Exchange recorded the surge in real time. On December 24th, the silver price on the SGE was 570 yuan per gram. By December 26th, it had climbed to 595 yuan. That is a 4% increase in 48 hours. And it does not include the additional costs that buyers face when they actually take delivery. The published exchange price is a starting point, not the final cost. When a Chinese buyer purchases silver on the SGE, they must pay a 17% value-added tax. They must pay for secure transport from the exchange warehouse to their facility. They must pay handling fees, insurance, and, in some cases, expedited processing fees if they need the metal immediately. When all of these costs are added together, the real price in Shenzhen was exceeding $80 per ounce. Meanwhile, bullion dealers in the United States were facing their own crisis. A dealer in Dallas had been selling Silver Eagles online for years. His business model was simple. Buy wholesale from distributors, mark up the price by $3 to $4, and sell to retail customers. But on December 26th, his distributor called and told him that wholesale prices had jumped to $78 and that inventory was limited. The dealer looked at his website, where Silver Eagles were still listed at $76, and realized he was about to lose money on every sale. He pulled the listing. Across the country, other dealers were making the same decision. Some raised their prices to $90 or more. Others marked their inventory as out of stock or switched to a pre-order model, telling customers that delivery would not occur until late January. The reason was simple: replacement cost risk. If a dealer sells a coin today for $78 and the wholesale price jumps to $85 tomorrow, that dealer cannot replace the coin without taking a loss. In a stable market, this is not a concern, but in a volatile market during Ghost Week, it is a catastrophic risk. The inventory drawdown was visible in the data. The COMEX warehouses, which hold registered silver available for delivery, had been declining steadily since November. On December 1st, registered inventory stood at 72 million ounces. By December 26th, it had fallen to 68 million. That is a 4 million ounce decline in less than a month. Where did it go? It went east. It went to Shanghai, Shenzhen, and Hong Kong. It went to the buyers who were willing to pay $80 instead of $74. This is what a broken supply chain looks like. It does not break with sirens and flashing lights. It breaks quietly, one transaction at a time, as metal flows from the place where it is cheap to the place where it is expensive. And when the flow becomes one-directional, when the arbitrage that normally balances the system cannot keep up, the market reprices violently. $80 in China is not a distorted premium. It is the real price, the price that reflects actual supply and demand in the physical world. $74 in New York is the illusion, a paper price that exists only because the futures market has not yet caught up to reality. There's a number that traders have been watching for 3 weeks, and that number is 75. It appears ordinary on a price chart, just another round figure among many. But in the options market, $75 is not just a price level. It is a loaded gun, and the trigger is 11 cents away. In a conference room in Chicago, a quantitative analyst named David Park was staring at his gamma exposure report. David works for a mid-sized market-making firm that sells options contracts to hedge funds and institutional traders. His job is to calculate how much risk the firm is carrying and how much hedging is required to stay neutral. On the morning of December 26th, the report showed something that made him reach for his phone to call his boss, even though his boss was supposed to be on vacation. The firm had sold call options on silver with a strike price of $75. A call option gives the buyer the right to purchase silver at $75, no matter how high the actual market price goes. If silver stays below 75, the option expires worthless, and the firm keeps the premium. But if silver goes above 75, the firm is obligated to deliver, and that means buying silver at whatever price the market demands. David's report showed that the firm had sold the equivalent of 8 million ounces in $75 call options, and silver was currently trading at $74.89. Options dealers do not like taking directional bets. Their business model is to collect premiums and stay neutral, which means they hedge their exposure by buying or selling futures contracts. The amount they need to hedge changes as the price moves, and that change is measured by a Greek letter called gamma. High gamma means the hedging requirement changes rapidly. And at $75, the gamma exposure on silver options was extreme. Here is what happens when silver crosses 75. Every options dealer who sold $75 calls suddenly needs to buy futures contracts to hedge their exposure. The closer the price gets to 75, the more contracts they need to buy. And because it is Ghost Week, there are fewer sellers in the market to absorb that buying pressure. This creates a feedback loop. Hedging activity pushes the price higher, which triggers more hedging activity, which pushes the price even higher. David ran the numbers. If silver hit $75 and kept moving, his firm would need to buy an additional 3 million ounces worth of futures contracts within the first hour. And his firm was just one player. Across the industry, banks and market makers had sold hundreds of millions of dollars worth of $75 calls. If they all started hedging at the same time, the buying pressure would be immense. The dangerous part is the speed. Under normal market conditions, a move from $75 to $80 might take several days. Buyers and sellers would gradually adjust their positions. Market makers would have time to hedge in an orderly way. But in Ghost Week, with liquidity at 30% of normal levels, there is no orderly process. There is only a race to cover exposure before the price runs away. In March 2022, the nickel market on the London Metal Exchange experienced a gamma-driven price spike that sent nickel from $29,000 per ton to over $100,000 in less than 24 hours. The move was so violent that the exchange halted trading and canceled billions of dollars worth of trades. The cause was a short squeeze combined with thin liquidity and forced hedging by options dealers. Silver in December 2024 had all the same ingredients. The COMEX does have circuit breakers designed to halt trading if prices move too fast. But circuit breakers are triggered by percentage moves, and a move from 75 to 80 is only 6.6%. In a volatile commodity market, that might not be enough to trigger a halt, and even if it does, the halt only lasts 15 minutes. When trading resumes, the same buying pressure is still there, and the algos come back even more aggressive. What makes $75 particularly dangerous is that it sits at the intersection of technical and fundamental pressure. Technically, it is a gamma wall that could trigger violent hedging flows. Fundamentally, it is the price level where the New York market begins to converge with the $80 physical price in China. Once 75 breaks, there is no natural resistance until 80. At 11:27 a.m. Eastern Time on December 26th, silver ticked up to $74.92. Then $74.95. David Park watched his screen and felt his pulse accelerate. He had already sent 3 messages to his boss. No response. The algorithms were buying. The market was empty. And $75 was 8 cents away. This is not speculation about what might happen. This is mechanical. When gamma exposure is this concentrated and liquidity is this thin, the move is not a question of if, but when. And in Ghost Week, when the humans are gone and the machines are in control, when can be right now. The paper price is 11 cents from breaking. The physical price has already broken. And when the two converge, the market will not ask permission. It will simply reprice, and everyone holding paper contracts will discover what they actually own.